Today, in under 20 minutes, I will provide you what you need to know if you want to invest in Super Microcomputer stock. Trading near $31 per share, I currently have a buy rating on Supermicro stock, but there are several key factors that have a major impact on this thesis that I'll go deeper on. I will give you the positives and negatives from the Q1 26 results, a breakdown of the three financial statements in my Wall Street valuation model, what other analysts on Wall Street say about Supermicro, and my conclusion on Supermicro's future and what you should do. So why should you listen to me? My name is Ken Freeman. I'm a CFA charter holder. I'm also a professor of finance and economics. I have 20 years of Wall Street experience, and I'm the guy that investment banks like JP Morgan and asset managers like BlackRock hire to train their financial analysts on Wall Street. In my research, I discovered 6 things that got me very excited and 6 red flags to watch out for with Supermicro. If you're enjoying this, please smash that like button. Supermicro missed Wall Street expectations on both revenue and EPS. This was the 6th consecutive quarterly revenue miss versus estimates, but guidance was above expectations.
Bad news, bad news.
Let's cover the red flags first. The company burned nearly $918 million in cash from operations in a single quarter. Negative operating cash flow at this scale pressures liquidity and raises execution risk during rapid growth.
Cash flow used in operations for Q1 was $918 million, compared to cash flow generated from operations of $864 million in the prior quarter.
Gross margin fell sharply compared to the prior year, despite massive revenue scale. Shrinking margins signal rising costs, pricing pressure, and weaker operating leverage.
Q1 non-GAAP gross margin was 9.5% versus 9.6% in Q4.
Quarterly results failed to meet investor expectations, leading to a significant price drop. Weak execution during a critical growth phase erodes investor confidence and increases volatility.
That's suspicious.
The company reported more total debt than cash on hand. Higher leverage reduces financial flexibility if growth slows or cash burn continues.
At quarter end, our cash position totaled $4.2 billion, while bank and convertible note debt was $4.8 billion, resulting in a net debt position of $575 million, compared to a net cash position of $412 million in the prior quarter.
A single large customer materially influenced quarterly results by altering delivery timing.
For Q1 fiscal year 26, we had 10% plus customers.
Customer concentration increases earnings volatility and bargaining power risk if key clients change plans. Competitive pressure in AI servers is flagged as a direct risk to Supermicro's growth narrative.
And that's no good.
Higher competition can force price cuts and weaken differentiation.
Well, competition remains intense. We are focused on capturing the tremendous AI infrastructure market share. Some large-scale builds have pressure margin in the near term, but our scale, innovation, and differentiate DCBBS offerings strengthens our market leadership and position us to deliver long-term profitability and shareholder value.
Here's what got me really excited. Supermicro reported a $4.2 billion cash position. Strong liquidity supports operations and near-term obligations.
At quarter end, our cash position totaled $4.2 billion, while bank and convertible note debt was $4.8 billion.
Revenue contribution from Asia increased materially year over year. Geographic diversification reduces reliance on any single region.
By geography, the U.S. represented 37% of Q1 revenues, Asia 46%, Europe 14%, and the rest of the world 3%.
Supermicro highlighted extreme thermal efficiency in its latest AI rack designs. Cooling efficiency is a gating factor for dense AI deployment at hyperscale.
Now that feels fresh. I like that.
Supermicro is positioned as a foundational supplier rather than a speculative AI software play. Being a pick and shovel provider anchors demand to infrastructure build-out cycles, not fads.
In summary, Supermicro is evolving into a leading AI platform and data center infrastructure total solution company.
Supermicro is a vital partner to NVIDIA, not a peripheral reseller. Supermicro is already producing liquid-cooled AI racks at industrial scale. Proximity to NVIDIA and producing at scale reduces execution risk. This is what everyone is missing. Management guided to $10 to $11 billion in Q2 26 revenue, implying sharp sequential growth. Guidance suggests that delayed shipments may convert into near-term revenue.
Now turning to the outlook for Q2 fiscal year 26, we expect net sales in the range of $10 billion to $11 billion.
When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition? That is exactly what you're doing when you buy a stock without understanding the 3 financial statements. If you want to see how I train the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. Inventories have been increasing to meet the demand, but it is important to not take on too much too fast, which results in write-offs. With increasing inventories to prevent write-offs, it's important to not let days inventory outstanding get too high. While it has been decreasing over the last 4 years, we did see a 41% increase in the last quarter, and we must keep an eye on this. Supermicro ended the year with $4.8 billion of debt, and the bulk, $4.65 billion, is in convertible notes. Convertible notes are dangerous because they can dilute shareholders in the future, and a high-growth company should not need debt to grow. Over the last 12 months, debt has increased 111%, while EBITDA has decreased 38%. This has caused leverage measured by debt to EBITDA to go from 1.4 to 4.8x. More than tripling debt to EBITDA in the last 12 months is unsustainable and is definitely something that we need to keep an eye on. Retained earnings is how we determine whether core equity value is increasing. Retained earnings has increased more than 5 times over the last 5 years. It has continued to increase over the last 12 months, but at a decreasing rate. So what's the takeaway? Supermicro has not managed rapid growth effectively. It has written off $259 million of inventory over the last 12 months, days inventory outstanding is increasing rather than being stable, and leverage is increasing to dangerous levels. The income statement shows us if the company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income, income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Rapid AI-fueled growth has resulted in top-line revenue increasing 6.6x over the last 5 years, but that growth has stalled over the last 12 months and even declined year over year in the last quarter. Stalled growth during an AI-fueled hyper-growth phase is a definite red flag. While gross profit has grown along with revenues, margins tell us a different story. Since 2023, gross margin has been on the decline. Year over year, gross profit is down almost 15%, and margins have been declining too. The quarterly trend is even more alarming, with a steady decline over the last year, and it has been below 10% over the last 3 quarters. A 1% decrease in gross margin equates to an $11.30 decrease in valuation, so it has a massive impact with margins at these razor-thin levels. Despite margin compression, net income has increased 12.4x over the last 5 years. Increasing costs did result in a net income decrease of 9% over the last year. Alarmingly, this trend has continued over the course of the last year, with LTM net margin getting cut in half from 7.6 to 3.8%. So what's the takeaway? Growth has stalled and margins are compressing, but Supermicro has a big backlog of business which they need to focus on fulfilling and doing so profitably. The cash flow statement tells us where the cash is generated by the company, and there are 3 buckets. Operating, which is the cash the company generates internally, investing, which is the cash demanded for long-term growth, financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash making this positive, not losing cash, which would make this negative. Every year, operating cash flow alternates from positive to negative. That same trend is seen quarterly over the last 12 months. Not only is this bizarre, it makes it extremely difficult to plan for the future. While you might think this is a capital-intensive business, it is not. CapEx has increased at less than half the rate of revenues over the last 5 years. Supermicro burned over $973 million of cash in the quarter. Even with $4.2 billion of cash, it won't last long if it gets burned that fast. So what's the takeaway? Supermicro is an inconsistent generator of cash flow and must be careful not to take on more debt or sell more equity in the future, both of which are bad for investors. So what do I think about Supermicro and what should you do? I'll get into that, but first, let's go through my valuation. On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we could take these future cash flows, discount them back to today to get a current intrinsic value of the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. As you can see on the left, we take specific line items that we projected from the 3 financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get to total enterprise value. To get to equity value, we strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments. We get an intrinsic equity value of about $26 billion. We divide by the current shares outstanding, we get an implied share price of $42.70. Compared to the current close of $31.07, that's a 37.4% discount, which is a buy rating. On Wall Street, if a stock is trading at greater than a 20% discount, it's considered a buy because it provides us a margin of safety. I'll give you my thoughts on how to play Supermicro stock later in the video. So what does Wall Street have to say about Supermicro? Let's cover that next. The consensus among Wall Street analysts is a buy, but the valuation range is very wide, and most have lowered their price target after the quarterly miss. Goldman maintained a sell rating on Supermicro and raised their price target to 34 from 30. Goldman cited a Q1 EPS miss, and they expect a sequential rebound on strong new orders, but stay cautious on profitability and margins. Barclays maintained an equal weight rating on Supermicro and lowered its price target to 43 from 45. Barclays lowered their price target, reflecting weaker visibility and compressed margins into fiscal 2026 guidance. Rosenblatt maintained a buy rating on Supermicro, but they lowered their price target to 55 from 60. Rosenblatt tweaked their price target after the guidance update while leaning into AI server demand and order pipeline. CapIQ gives me a sense of how other analysts on Wall Street view the company. 17 analysts cover Supermicro on Wall Street. The range is from a low of 15, which is a 52% decrease, to a high of 93, which is a 199% increase. The median is 48, which is a 54% increase. The overall rating on a scale of 1 to 5 is 2.58, which is a hold rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I personally do not have a position in Supermicro. The growth story has stalled out a bit, and moving forward, execution is paramount. Stick around because I'll reveal the ideal entry point if you decide to become a Supermicro shareholder. Here's what investors must watch out for. Federal regulators issued subpoenas tied to a short seller report. Regulatory scrutiny can drag on results, reputation, and management focus. Multiple executives and directors sold shares during a steep stock decline. Insider selling amplifies negative sentiment during periods of volatility and doesn't make sense at these levels. Forbes data shows that Supermicro has historically rebounded strongly after major sell-offs. Past recovery behavior suggests sell-offs have often created snapback scenarios. Management disclosed more than $13 billion in Blackwell Ultra orders. A large order book supports future revenue visibility despite near-term execution challenges.
Our NVIDIA Blackwell Ultra base GB300 product line now have more than $13 billion in back orders, including the largest deal in our 32-year history, reflecting the tremendous growth potential in hyperscale and enterprise deployments.
Supermicro hit a 52-week high of 66.44 in late February 2025, and it's down over 53% since then. My model shows a value of $42.70, which is a 37.4% discount at current levels. On Wall Street, we buy with a margin of safety of at least 20%. So, Supermicro is a buy at current levels, and if you're interested in buying Supermicro, I'd be looking to buy at $35.60 and below to provide a 20% margin of safety. Supermicro is a leader in the niche space of high-efficiency server racks, which will be important for data centers moving forward as AI continues to grow. With slowing growth, compressing margins, and increased competition, investors must remain cautious. If you like this and want to see another in-depth stock valuation, check out my Lululemon video here or my Microsoft video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.